he announced the dismissal of a member of the governing board of the nation's main issuing institution, thus crossing the inviolable taboo that for decades had separated electoral power from monetary power. It sounded like a challenge to all those who had long considered the central bank the last impregnable fortress of professional autonomy. Following the statement about a valid reason for removing Lisa Cook came immediate market fluctuations, distortions in yields across maturities, and alarming comments about the erosion of trust in institutions. The market said aloud what had long been whispered in offices. Political pressure on the regulator was no longer a hint, but a fact. The scandal had an explosive effect not only because of Cook's own figure, whose biography had long been a symbol of inclusiveness and expertise, but also because of the precedent itself. In the entire history of independent monetary authority in the United States, no president had ever directly fired a sitting member of the governing board. Legal experts emphasize that the phrase "for cause" with regard to board members is interpreted narrowly and enshrined in law. So the attempt to conceptually shift the boundaries of what is permissible looks like a provocation that shocked society and instantly politicized the issue of independence. Lisa Cook refused to accept the dismissal, stating that the White House had no authority to strip her of her mandate and is preparing a lawsuit. This added a judicial intrigue to the story and moved the dispute into the realm of constitutional guarantees and the balance of powers. Ahead looms a case in the highest court, where what is at stake is not the personal fate of one economist, but the architecture of the central bank's autonomy itself. The world held its breath. At stake is not only procedural integrity, but also the regulator's ability to make unpopular decisions when the cycle demands it. The market reaction became a textbook illustration of how politics penetrates the price of money. Longer-term issues rose in yield, factoring in the risk of an inflationary tilt and a premium for politicization, while short-term rates fell, reflecting expectations of a softer rate path under leadership perceived as more compliant. The yield curve steepened at the long end, and the U.S. currency weakened. Worrying signals that analysts had been warning about for years finally materialized in numbers and quotes. In the media space, it sounded like a grand turn, from rhetorical war with the regulator to an attempt to actually seize control points in its bureaucracy. The move to remove Cook fell in line with public criticism of the chair, the accumulation of loyalist appointments, and the idea of taking monetary policy hostage to the political calendar. All the world's outlets are discussing, from front pages to economic columns, whether presidential power can reach what for decades was considered out of reach. At the level of facts, the dramaturgy is clear. In the governing board, each seat weighs far more than it appears, and replacing one vote changes the configuration of a majority in such a small body. The nominee being discussed by advisers fits into the idea of an ideological reset, a loyal orientation toward accelerated easing, criticism of previous approaches, and a willingness to vote for faster rate cuts. Insiders say that together with previously formed sympathies, this could give the political center leverage over the regulator that previous administrations could only dream of. The personnel intrigue is compounded by departures and reshuffles that expose the institution's vulnerability to an abnormally high political temperature. Every vacant mandate becomes a stake in a roulette game where the balance of independence spins. Where is the line between professional disagreement and voting on command? While lawyers note that Cook's guilt has not been proven and the claims rest on public assertions from the political bloc, the central banking community in other countries sees its own risks reflected. If it can happen here, why not there? The immediate consequences are already reflected in the cost of servicing debt. The higher the suspicion that monetary policy will dance to the march of political slogans, the higher the premium built into long-term money. For a simple investor, this means that any debt auction will have to be sold at a bigger discount, which in turn means taxpayers will pay more just for the state's right to borrow. This is not a catastrophe today, but it is a troubling slope of a trajectory that, if it sticks, will lead to a systemic rise in borrowing costs and a flow of capital into safe haven assets. In parallel, the topic of price stability bursts into public discourse. Will inflation rise if the regulator is forced to accelerate the lowering of the cost of money? Investors, accustomed to reading between the lines, are adjusting models to a scenario where short-term rates will ease faster than the macro cycle dictates, and expectations over a several-year horizon will edge up slightly. Inflation hedges are becoming more expensive, and the market structure is warping. What was yesterday a textbook case for economics students has today become a political reality. Finally, the very semantics of the dispute over presidential powers broaden the scope of the situation. If the court recognizes the precedent of removing a board member with a formulation that can be interpreted flexibly, then in the future, any inconvenient voice will be under constant threat. Independence will then be not a legal norm, but a favor granted by political expediency, and the entire edifice of trust in monetary policy risks becoming a fragile facade. This prospect frightened the markets most of all. At the heart of the conflict is a long history of mutual hostility between the political center and the institution, whose task is to maintain price and employment stability rather than move in step with the electoral calendar. Even in the previous cycle, the rhetoric of accusations of too high rates had to be taken as political noise, but over the years this noise turned into a system, from public pressure to a personnel campaign aimed at turning the regulator in the desired direction. The attempt to remove Cook is seen as the culmination of this line, not as an impulsive episode. The context matters also because in the governing board, every vote carries disproportionate weight. The 7-member structure is designed so that replacing one participant changes the architecture of objections and strategic coalitions. When loud statements about readiness to cut rates regardless of current dynamics are added to this, the impression of political control over the regulator intensifies and fuels the suspicion. Are we abandoning the time-tested division of labor where the central bank makes unpopular decisions and the political bloc bears the costs? The pressure is also heightened by the campaign to fill vacancies with people who share the course toward sharp easing. In the professional environment, the name of an economist known for skepticism toward the previous line is being cited, and there are warnings that if the loyalists secure a majority, monetary policy will lose its counter-cyclical teeth. The sum of the signals forms one picture. The regulator is being pulled into a space where political goals prevail over anti-crisis methodology. This is no longer a dispute over tactics, but a battle for the soul of the institution. The international background makes the situation even more delicate. In a world where central banks have repeatedly pulled economies out of the vortex of shocks, from the financial crisis to pandemics, undermining trust in the planet's largest regulator is seen as a blow to the global insurance system. Heads of other central banks are making it clear that political interference in monetary policy risks importing instability through exchange rates, interest rates, and capital flows. The issue ceases to be national and becomes global. The special energy of the scandal lies in the fact that it coincides with a moment of expectations for easing. The markets were already living under the assumption that the cost of money would begin to fall after the cooling of certain indicators. Now, to the objective arguments, a subjective trigger has been added. The desire of the political center to speed up the process. This has intensified talk that the trajectory will be not so much economic as political, and this changes investor behavior and raises the cost of error. Within the country, the reaction has been diverse, from enthusiastic approval in camps longing for cheap money and rapid growth to harsh accusations of authoritarian habits. Human rights organizations have seen in the personal choice and method of implementation a link to the ideological wars of recent times, where the fight against diversity and inclusion programs has become a marker of the political campaign. The opposition calls what is happening a shock and a provocation that has shaken society, while some moderates warn of the risk of building into the system a long-term procedure for political purges. On the international stage, restrained but firm wording is heard. From European offices to Asian funds come signals that undermining the independence of the regulator of the world's reserve currency is like playing with fire. Regulators in other countries fear a domino effect. If constitutional barriers in one jurisdiction give way, public pressure in others can quickly bring politicians to similar experiments. This is not only about norms, it is about the cost of money on the planet, where every move by the largest issuer sends waves to all shores. The financial community is reacting pragmatically, reassessing the rate path, ensuring portfolios against an inflationary bias, nervously watching debt auctions. Analysts' comments, from morning channels to evening summaries, converge on one thing. The very possibility of political diktat over the regulator is already valued by the market as a risk that must be priced in. In some places, this causes a nervous tick. In others, a cynical smile. But the general mood is the same. Caution, because the mechanics of trust are being tampered with here. Media platforms have flared with headlines comparable in loudness, only to pre-crisis times. Everywhere there is discussion of whether the judiciary can quickly put up a barrier and return the system to its usual course. Some see what is happening as the logical continuation of a political line toward dominance over independent institutions, others as a tactical maneuver in bargaining over the economic agenda. On all channels, two words are repeated: independence and trust, and both sound like proper nouns on which too much depends. Foreign outlets, describing the sharp moves in yields and the weakening of the US currency, add an important caveat. Reactions are still local and uneven, and a significant portion of investors prefer not to make abrupt moves until the legal outlook becomes clear. But even this wait-and-see stance is read as the new normal. Caution becomes the baseline scenario because the rules of the game can be rewritten at any moment by a political gesture. Troubling signals are multiplying faster than press offices can issue them. Speculation and theories are multiplying geometrically, from the simple to the paranoid. The most down-to-earth theory speaks of the desire to accelerate rate cuts in order to spur growth and show electorally pleasing figures: cheap mortgages, revived stock indexes, cheap loans for business. At first glance, this plot fits into political logic. Give the economy a dose of stimulus and credit the effect to the valor of the authorities. But this version has a flip side. The market-swallowed signal of the regulator's subordination may cost more than the potential growth surge. Another theory goes deeper. It is not so much about the short-term situation as about the strategic capture of those institutional nodes that hinder centralized management of the economy. In this, the choice of a symbolic target is logical, a figure around whom it is easy to ignite an ideological dispute, thus turning a legal discussion of dismissal grounds into a cultural war. This technique is well known from other fronts. Where the agenda explodes, it is easier to push through personnel decisions. A third, more pragmatic version reduces everything to a bargaining for control over the majority in the governing board. If a replacement can be made and the loyal bloc strengthened, any dispute over the rate path will turn into a technical procedure. The minority's position will be dismissed as academic exoticism. Then, even without direct orders, the desired trajectory can be achieved. It is enough for rhetoric and expectations to work toward one goal. Such is the power of expectations in monetary policy. They can be shaped not only by forecasts, but also by personnel architecture. There are also conspiratorial shadows, from attempts to distract attention from other personnel conflicts to a desire to provoke opponents into legal mistakes in order to later cement precedents for future years. These versions do not need proof to multiply. The pace of the news flow and the atmosphere of universal suspicion are enough. But they all work toward the main effect: undermining trust, without which monetary policy turns into a ritual without magic. Insiders say that in the coming weeks, a series of steps will be taken, from filing lawsuits that will put the dismissal attempt on hold to lobbying efforts around candidates for vacant seats. Political staffs are preparing talking points for broadcasts. Legal teams are gathering references and precedents, and the market is meanwhile continuing to reprice discounts. In this bustle, the most valuable currency is time, because it is time that turns a scandal into a structure, and noise into a norm. The official version sounds tough and confident. The presidential office claims that there are grounds for dismissal that fall under the law, and therefore the step is justified and necessary. The stated reason is mortgage discipline violations, a phrase that fits well into the media cycle, but requires proof and procedural integrity. In response, Cook's camp issues an unequivocal reply. The authorities have no such powers. The dismissal is not accepted, and the mandate will be defended in court. Between these two positions lies the legal field, where any misstep could be fatal. Alternative versions from sources in the professional community say otherwise, about the ideological disagreement of the board member with the course toward forced easing and about principled voting that irritated the political center. In this interpretation, valid reason becomes a euphemism for punishing independence of judgment. Economists speaking on condition of anonymity add that even the public discussion of the legal possibility of dismissal itself pressures colleagues on the board. The intimidation effect works better than formal orders. Insider feeds drop details about preparations for a possible replacement. The lists include specialists known for criticizing the moderately tight line of recent years and inclined to prioritize growth. If such a scenario is implemented, the balance on the governing board could shift in favor of faster easing. Outwardly, this will look like a reasonable course correction. Internally, it will amount to cementing a mechanism of political coordination of monetary policy. On the opposite flank, the voices of legal scholars remind, The law does not allow arbitrary dismissals, and the valid reason clause has historically been interpreted strictly, with a high evidentiary bar. They warn that attempting to expand this formula to politically inconvenient behavior will become a dangerous precedent, devaluing the principles of separation of powers. For the central bank, this is equivalent to removing the insurance against populism, the disappearance of the right to say no when it is easy to say yes. Finally, market-focused publications add a note of cold calculation. If the goal of pressuring the regulator coincides with an already planned easing trajectory, the short-term effect on quotes may not be dramatic. But even in this case, a deeper consequence arises: the blurring of boundaries between independent analysis and political desire, which in the long run costs more than any difference of a few basis points. This is precisely the case when the cost of trust becomes the most expensive item on the balance sheet. Next comes escalation. The legal collision could turn into a long-running series, where each episode, from temporary injunctions to hearings on the merits, will drag market attention from charts to court transcripts. If the highest court limits presidential powers and confirms the strictness of the valid reason criterion, the regulator will get a breather and a chance to restore moral authority. If, however, the court, even without agreeing on the merits, allows de facto removal during proceedings, the architecture of independence will get a crack that will be hard to patch with subsequent decisions. In parallel, the personnel strategy could accelerate. Every day of uncertainty pushes the political center to occupy vacant positions, consolidate votes, and cement the course toward easing. Then the governing board will have a new majority, and even with a legal loss in the Cook case, actual control over the rate trajectory will be in the hands of the political center. In such a scenario, the market will see not just a change in personnel, but a substitution of the very principle of refusing political diktat. Through trading floors, the echo will reach fiscal policy. The more expensive long-term borrowing becomes, the harder it is to finance deficits, and the more painful any downturn in the economy. An increase in the premium for politicization risk can gently but persistently push investments out of the real sector, shifting appetite towards safe haven assets. In such a world, the central bank ceases to be an anchor and becomes a variable in the equation of political struggle, meaning every macro indicator will be read through the prism of intrigue, not just statistics. Finally, the global contour. Partners and competitors instantly draw their own lessons from this story, from commodity economy regulators to the financial authorities of developed countries. If the reserve issuer allows interference in monetary policy, then the global price of trust rises, and with it, the cost of any international projects requiring long and predictable financing. An overdose of political control over the money printing machine in one country inevitably resonates in the financing of another, and this is no longer the plot of a single capital, but ripples across the entire surface of the global sea. The plot has quickly moved from the category of isolated scandals into that of tectonic shifts, where the bet is not on winning one case, but on rewriting the unwritten rules of coexistence between power and the regulator. No one knows how far the sides will go, what other moves are prepared in headquarters, and in which offices counter-doctrines are already being drafted. Only one thing is clear. The worrying signals from the market and the legal sphere no longer look like short-term noise. They sound like the overture to a long drama in which the independence of the central bank will be tested as never before.